Okay, so what I want to do is just give a brief overview. So the motivation essentially is to have some macro models which bridge essentially macro, finance, and monetary research. So that's essentially what we want to do. And why is finance so interesting? Because the financial frictions are key in understanding the business cycles and other movements in the economy and inefficiencies. And the financial sector actually helps to overcome some of these financial frictions. But the financial sector, essentially, depending how well it's capitalized, is also moving over the cycle. So essentially, it is better or worse in overcoming these financial frictions, and that actually amplifies the initial shocks and leads to more persistent shocks. There's some okay. And then we will also cover a little bit of the international perspective, because you can use these models with financial frictions in international setting as well. And today and tomorrow morning will be primarily in a continuous time framework. So that's what Yuli and I were working on. We think this is a tool which is a very useful tool, which opens up many different avenues and possibilities using this tool. So more generally, there are three stability concepts you keep in mind. So one is price stability. You would like to have low inflation, or at least no extremely high volatile inflation. You would like to have that the financial sector is stable. For this, you want to use macroprudential policy, while for price stability, you use monetary policy. And you also want to make sure that the fiscal debt is sustainable. So that's related to the fiscal policy. So you cover monetary policy. Fiscal policy is very traditional macroeconomics, but actually after the crisis, what came much more prominent is the macroprudential aspect to it. And then the question is, what are the different tools and instruments you have as a policymaker? For monetary policy, it's typically a short-term interest rate and some, monetary policy rule, which then also has some implications on the whole term structure. And again, if you want to study some term structure models, continuous time frameworks are much more elegant to deal with term structure problems. On the other hand, if you want to cover the macroprudential policies, there's a whole bunch of tools now available: reserve requirements, capital and liquidity requirements, collateral policy, margin haircut policies, capital controls in international contexts. So there's a lot of additional tools, and all these tools and instruments, they interact with each other, and there's a lot of stuff essentially to be done. So going back in history, where you say in economic thinking, how important were financial frictions and what were the methodologies used? So going back to Fisher, Keynes, and early writers, it was finance played an important role in macro, and the key at that time of the method here was verbal reasoning. There were no models. And then after the Second World War, if one wants to say this, essentially macro and finance split apart, going in different directions. While macro focused very much on a dynamic setting, in growth models, and also in continuous time, it was very, very much deterministic. Okay, so the initial models were all deterministic. There was no uncertainty. On the other hand, finance actually moved into models. Just here is portfolio theory, where you have a static problem, but you have risk. So you don't ignore uncertainty, but you move to a static problem. You don't have a dynamic problem. The macro folks were focusing much more on the dynamic aspects, but from a deterministic perspective. And then in the 70s, roughly in the 70s, macro introduced the stochastic element. So you have, mostly in discrete time, you have the stochastic models. So Brock-Meerman comes to mind, Stokely-Lucas pushed it through the book also. And then you have the whole DSG models, dynamic stochastic general equilibrium models in the new Keynesian framework. And that's essentially when macro went from purely a dynamic setting to a dynamic and stochastic setting, but it still stayed in discrete time. In contrast, also similarly in the 1970s, finance moved away from purely stochastic elements without dynamics to introduce dynamics as well, but did it much more in continuous time. And it was also because the stochastic calculus framework was built and was developed in the 1960s, 70s. So option pricing, Black-Scholes, term structure models, Cox-Ingersoll-Ross, Yulee worked on a lot of continuous time agency theory and so forth. And what we think is essentially what you can bring this now together, you can actually use this continuous time tool also in the macro framework. And that's essentially what we want to do the next few days. This is a difference how the methodology evolved over time. The other aspect is how did the thinking evolve. So what are the primary frictions which drive the macroeconomy? And I make it a little bit a black-white thing. Of course, it's not so black-white in the real world. It's much more gray. But before the crisis, the primary friction people focused on is price and wage rigidities. That's where the new Keynesian framework comes in. After the crisis, essentially, the emphasis shifted away from price rigidities, for example, modeled a la Calvo, to financial frictions. Before the crisis, also what mattered, if you know dynamic model in terms of expectations, what matters is actually the cash flow, the future realized outcome. And for example, if you look at the term structure, it was based on the expectations hypothesis. So essentially the yield was just the expected future short-term interest rate. That gives you the yield. So the expectations hypothesis was very important and was always assumed and still assumed in many, many macro models. If you look at the credit spread, it was just the expected default. While after the crisis, the endogenous risk mattered much more, and the risk premia played a very, very important role. So in finance, risk premia played a much more important role already early on, before the crisis. The shift came earlier in finance, but the shift was essentially moving away from an expectations hypothesis where only the cash flow, the payoffs matter, but also the risk premia themselves move around. And there I get a term risk premium, a credit risk premium, and sometimes this premium is a black boxy thing, so it's very hard to grasp. But the change in price is not just the change in expected future cash flows, but also a change in risk premium. The key equation, you might say, is, before the crisis was the Euler equation. It's still an important equation, but once you have financial frictions, the repressive agent framework doesn't hold anymore, so you have to take care of wealth distributions, how the wealth is distributed in the economy, because you have heterogeneous agents, and these heterogeneous agents have different wealth, and the wealth distribution itself becomes a state variable. And that will be key in all these models, that there will be new state variables. And typically we have only two types of agents in order to have the wealth share as one key state variable. What is the heterogeneity? The heterogeneity can be in many ways. There can be people who are poor today and rich tomorrow. Others are rich today and poor tomorrow, so they borrow and lend to each other. There can be productive and less productive. That's what we will focus on a lot. There's some subgroup of people who are more productive than other people. There might be difference in preferences, for example, in patience or in risk aversion. And there might be also difference in heterogeneous beliefs. So we will not go so much in heterogeneous beliefs framework, but there's a lot of literature out there where some optimists and pessimists have heterogeneous prior beliefs, and then after updating, they still have heterogeneous posteriors. So it's not only asymmetric information, where everybody starts with common priors, gets different signals, and then they disagree, but they really have different prior beliefs. And again, if you have financial frictions and this lending or insuring across these groups is not working well, the wealth distribution matters again, as I mentioned before. So what we will focus on, we will focus primarily on productive versus less productive guys, and to some extent the difference in preferences. We will focus less on the differences in beliefs, and the primary reason for that is that it's much more difficult to do some welfare analysis if you have heterogeneous beliefs. So that's very hard to do. It's also the case after the crisis, the number of models which came based on heterogeneous beliefs is not so large because the welfare and regulation implications are much more difficult to grasp because we don't have a good welfare benchmark for that. Now, if you go to these distortions, what are the type of distortions? You can have these belief distortions, and you can match it with some belief service. But you can also have financial frictions, and the financial frictions come with different flavors. So you can have very simple and incomplete market setting, and that's what we will assume in many of our models. And there will be a natural limit how much leverage you want to take, because you might be risk averse. So there's no leverage constraint. It's just an incomplete market setting. The way to view that, you have here two states of the world, and you can only trade along this red line. No? Oops. And that's one way to view that. And there's a debt limit. That would be an additional constraint. But incomplete markets means you just can trade in a subspace of this state space. Then you can have a leverage constraint on top of it. So you can have an exogenous limit, how much you can trade. That's like in the Bewley models, Ayagari models, where you can actually borrow up to a certain limit. So let's suppose the red line is a bond contract because it's a 45-degree line, but you can only issue bonds up to this level. That's an exogenous limit, and that's, in all the Bewley, Ayagari, Cosell-Smith type of models. That's what's going on there. But you can have more general debt limits, which the debt limits depend on the asset price itself. Then it's a collateral constraint. And the collateral constraint is like how much you can borrow B, and the R is 1 plus little r, that's the interest rate, has to be smaller than tomorrow's price of this underlying capital. That's what's, for example, what's assumed in Kiyotaki and Moore. So that's if the collateral price tomorrow goes up or is expected to go up, then actually you can borrow more today. So it's the debt limit actually is endogenous and depends on the endogenous price, which then can lead to feedback effects. What some people do is they don't assume tomorrow's price, but today's price, because it's easier to handle. That some papers do that, but it's not so complete as tomorrow's price. And in Kiyotaki-Moore, essentially, that's a deterministic setting, so it's tomorrow's price. But in many models, there's uncertainty, and uncertainty said, what tomorrow's price? You can take the worst realization of tomorrow's price, or you can take the value at risk. So there's a distribution of tomorrow prices, and take the value at risk, the 1% value at risk. So that's things like John Giannakopoulos, or my paper with Lasse Petersen, we take the value at risk. John Giannakopoulos endogenously comes out that you have the worst price tomorrow. And then you can also have surge frictions. We won't go into the surge friction framework, but these are the different types of financial frictions to look at. Now, there are different types of liquidity. So that's another aspect, I think, interesting to understand. And this will come up also in the papers and in different parameters. You will see, there's different forms of liquidity. Some on the asset side of the balance sheet and some on the liability side. So one form of liquidity is the technological liquidity, which refers to what's the reversibility of an investment. If you build a machine, can you make it back into consumption goods or not? So what's the reversibility? And we will have this adjustment cost framework, which is very standard in macro, which makes it hard to reverse or convert a consumption good in a machine and a machine back into consumption. If it's very flexible, then of course Tobin's Q is always 1. So if it's a linear function, the investment from consumption, investing a consumption good to make a capital good, and you can even go the other way around, then you don't have some technological illiquidity. Market illiquidity is more like what is about the capital. If you were to sell the capital at bad times, how much would be the price impact? Okay, so that's what was market liquidity. So both of these two liquidity concepts, that's more the price, how the price will react if you were to sell it and if you sell a larger amount of it. And then on the liability side, you have this funding liquidity. So for example, you buy a machine which has, a life of 10 years, and you fund it with overnight debt. So the funding liquidity depends on the maturity structure of the debt. Okay, you can fund this 10-year machine, which has a lifespan of 10 years with 10-year debt. Then you don't have any maturity mismatch. But if you fund this with 1-year debt and you have to roll it over every year, then you have this maturity mismatch to handle. And this holds for market liquidity, and funding liquidity holds for physical capital. This also holds for assets, financial assets. So any type of assets. So you can think of, you buy a certain asset and you fund it then with overnight debt. Then you have some maturity mismatch. So if you buy a 30-year treasury, you fund it with overnight debt, you have a lot of maturity mismatch. But people would say it might be risky because there's a lot of maturity mismatch, but it's not so risky because whenever there's a crisis, the US Treasury is a safe asset, so it will appreciate in value. So the market liquidity is very, very, very good of the US Treasury. So it doesn't really matter that you have a 30-year US Treasury funded with overnight debt. So it's much less risky compared to other things. Let's say you have some other asset, some mortgage-backed security. If there's a crisis, it will tank a lot. Okay, so what really matters is not the maturity mismatch, but the liquidity mismatch. Okay, so if there's a very little market liquidity because you buy this 30-year mortgage-backed security asset and you fund it overnight, that's what really matters because there's a lot of liquidity mismatch. And buying a 30-year treasury, funding with overnight debt also has a lot of maturity mismatch, but it's much less risky because the liquidity mismatch is not so pronounced. Why is this liquidity mismatch so important and interesting? Because it's a measure how people will react in times of crisis and are forced to react, because if your funding is very short-term, highly levered, then you might be forced to fire sell, so your response will be very different from somebody who has funded it solidly with equity, and he can actually, when the price drops, he can actually buy even more of these assets. So there's a cheap buying opportunity, but if everybody is constrained, has a very bad liquidity match position, then it might be fire sales and so forth. So what I want to do is, so I mentioned the types of the distortions. What are the phases in financial crisis and all this? I would say there's a run-up phase, then there's a crash phase, and then there's a recovery phase. And I would just want to go the basic themes which you can talk about. So the run-up phase might be due to the distorted beliefs, so there's always a concentration of risk. And then there's the crash phase, and then I will talk about the recovery phase briefly. So there's also, when you think about what are the definitions or the elements of systemic risk, there's no agreed upon definition of systemic risk, but one way you can think there are two main elements. One is a time series element, which says the risk is actually building up over time, and then it materializes in times of crisis. But when the risk is building up, the volatility might not be so high, but just the risk is building up in the background. And that's related to something what Julie and I call this volatility paradox. So contemporary measures of volatility might not be a good measure of the risk in the system. So measures like liquidity mismatch might be better to capture what's going on. So if you see the underlying volatility is not very high of these assets, but the funding is much more short-term, then actually it might be an indication that the risk is building up in the background. That's the time series component. Then once you're in the crisis, so the first one, in order to go against it, you can do some preventive measures. That's part of the macroprudential toolkit to prevent this risk buildup. So once you're in a crisis, you have this crisis management, and then you have cross-sectional implications. So it's less about the time series, about the cross-sectional implications. And then you have spillover effects, contagion effects, amplification effects. Then you have domino effects. If contractual links are there, so I have a debt contract with somebody, I default on my debt, I bring essentially Max into difficulties, and because Max in difficulties, it goes on to Matthias and so forth, their network spillover effects. But more importantly, I think there's indirect spillover effects where we don't have a contractual relationship at all, but we have similar assets. I fire sell my assets, and that leads to situations where the position of somebody else is also jeopardized, and he has to fire sell, and we just enforce the whole thing. And that's essentially the second phase, the crisis phase. And then there's the recovery phase, which I don't have on this slide here. Now let me go to the run-up phase. So that's the run-up phase, and I go through the run-up phase, the crash phase, and the recovery phase briefly. And there are different ways. You can have one reason you can have run-up phase because of distorted beliefs. And one way is that we all become over-optimistic and we push up the asset price. That's a simple way of doing things. An alternative way is to have heterogeneous beliefs. Somehow we are optimists and pessimists and they're trading with each other. And this might actually lead to some prices which are overly distorted. You can easily see if there's some optimists and pessimists and there's some short sell constraints, the pessimists can't go short and the optimists can buy, so it push up the price too much. But if you know the literature by Harrison and Krebs and also Schenkman and Shaw, we can see that actually price can be above the most optimistic price because of this resell option assets have. So there might be bubbles emerging because of these heterogeneous beliefs. If there are short sell constraints, that the price is actually higher than the most optimistic guy would value it if he had to hold it for a long time. And that's the case if they're switching between optimists and pessimists over time. So the optimist holds it. He knows that there might be some guy who will become optimistic again. He can pass it on to somebody else. So that's why he's willing to hold an asset which is more optimistic than the asset price is higher value than the most optimistic guy is valuing it because he's hoping he can fire sell, or he can, or not fire sell, he can sell it at an even higher price as somebody else. So that's just a switching heterogeneous belief. So with heterogeneous beliefs alone, you can have the marginal buyer is switching. So who is the guy who values the asset the most, and you can figure this out who are the marginal guy. But you can have the switching heterogeneous beliefs, which leads to this resell options I mentioned and the speculative element a la Harrison, Krebs, Schenkman, Shaw. Now we will focus, as I mentioned earlier, we will not focus much on this heterogeneous beliefs framework. We will focus much more on common priors. So everybody starts with common priors. So there's not so much heterogeneous beliefs. And there will be a concentration of risk. So what I've depicted here, so you have, let's say, uniform distribution of people between households and experts, and somehow the risk is much more concentrated among these experts. Okay? And as you run up, in the run-up phase, the risk gets more and more concentrated. So, and that's essentially what will come up in the work Yuli will present just in a minute, so I won't go so much into it. So the experts hold most of the aggregate risk in good times. There will be low volatility in good times, but then, something might happen. And there's some models in which there's a credit cycle, in some models which there's a leverage cycle. So what's the difference? The difference is that in the models with credit cycle, it is the case that credit is building up in the boom phase, and then there's a crash and credit is going down. Okay, that's essentially in Bernanke, Görtler, Gilchrist. That's in Kiyotaki Moore. That's in my work with Yuli in the AR. And what's a leverage cycle? A leverage cycle is even more extreme. Essentially, not only does credit expand and in the boom phase and then contract in the crash phase, it moves so extreme that the credit movement is actually more pronounced than the equity movement of the experts, let's say. Okay, so in the boom phase, credit moves up and equity is moving up as well. But then the leverage, which is the leverage, so debt versus equity, that's a leverage. So the leverage is actually going up, and then in down phase, the leverage is going down, which means the debt is going down, equity is going down too because there are losses in the system, so equity is going down, but the ratio is going down even further, so debt is moving much more dramatically than equity. Okay, and there's a controversy in this in the profession whether this is really the case that there's really a leverage cycle. And this depends very much how you measure leverage. Book leverage, market leverage, all these things. That just, I would like to alert you to that. Now, let me move a little bit to absorbers versus amplifiers. So I think I mentioned already, there's this network, we have contractual links, but we might also have this virtual links where we say, okay, I have a similar position than Matthias, and then because I fire sell, I have to bring Matthias into difficulty. So we're virtually linked even though we don't have any contractual links. And the question is now, if we go into a crash, is it the case that we have amplification, we have fire sales? Let me just throw a question. So fire sales fire cell externalities, amplification, is this all the same? So what's your thinking? Does anybody have a take between amplification and fire cell externalities, let's say? But it's not actually, if you think more carefully, it's not so clear that they're connected, but externalities are slightly different from, and I want to spend a little bit of time from amplification concepts, which are due to strategic substitutes and complements. Okay, so the amplification is typically when you have strategic complements. So I'm going to just give a big picture here. Essentially, simply an externality is that if the others x minus I, so that the others act more aggressively, it will affect my utility, and it can be a positive or negative externality. Typically, what we study here is pecuniary externality, so it works through the price. So if I buy more apples, I push up the price of apples, and that's bad for somebody else who wants to buy apples. So that's a pecuniary externality. And typically with complete markets, has no welfare implications. But with incomplete markets, it has some welfare implications. So the externalities is mostly, it's about welfare, understanding welfare. An externality is about payoffs. How will payoffs react if somebody does something more aggressively? The strategic substitutes and complements, that's what leads to this amplification, is that, oh, if somebody does something different, how will I react in my action? So not how does my payoff react, so how does my action react? So it's essentially this cross derivative of the utility function, because this ui with derivative with xi is in my first order condition comes, and then how does this change as the others change the action? So that's where the strategic substitutes and complementarities kick in. So while the fire cell externalities and all this is on the top, this is the externality thing, the amplification is much more about the second one. Okay? And you can see that you can have positive externalities, and nevertheless, there's no connection. Strategic substitutes and complements can be both things. So, okay, so in theory, can go either way. Let me just illustrate this in a simple diagram, and I find this, it's probably very simple, but it's illustrative. So what I've depicted here is there's the average action of the others, and there's the I's best response. Okay, and so let's suppose on average the others are picking this point. So I have to move. I can move along this dashed line somewhere, and here's my indifference curve, and so that's what's going on. So if the others pick a higher point, I will be on this. You don't see it, but there's another dashed line, just imagine. And then I will be on a different indifference curve here, on a lower indifference curve, because this is the gradients of my utility. So I will be on a lower indifference curve. So if the others do more, then actually I have a negative externality. Okay, that's a negative externality. But I can also, and the optimal point for me, that's for this line, is this pointer. That's my best response then. I can have a positive externality, then my indifference curves would look like that, okay? But I have the same optimal point. And I say, okay, if I start out here, so average action initially was here, so the equilibrium, my best response is here, that's the 45-degree line, it's a symmetric setting, so that's the equilibrium. But if the others, act less aggressively, hold fewer assets, then actually in this setting, I would like to hold more, so the strategic substitutability. Okay, but you can see in both cases, whether it's positive or negative externalities, in both cases it was a strategic substitute. Okay, so these two concepts can be totally separated from each other. Now, in the case where then the best response is not going upwards as I go back, but downwards, then I have strategic complements. So that's a different utility curve, but these are strategic complements. And that's why the lesson essentially is that externalities and strategic complements, they're different concepts, but of course there's some link too. Now, for example, if the externality is always zero, then if this derivative is zero, then this will be zero as well, for example. Now let me just work. So the big question for the financial stability is always whether the other players are shock absorbers or shock amplifiers. So the question is always, there's some negative shock, and then suddenly the price drops, do the others see this as a cheap buying opportunity and go in and buy? Or do the others say, oh, wow, I'm constrained now too, and I have to fire sell into the market, okay? So the guy who has a liquidity mismatch, which is very stable and all this, they say, oh, wow, the price jumped from 100 to 80. That's a great buying opportunity. He jumps in and he stabilizes the market. So he's a shock absorber. The guy who has a very bad liquidity mismatch, he says, oh, wow, they moved from 100 to 80, so I'm really close to my constraint here. Now I have to fire sell as well. It becomes an amplifier. And the question is, shock amplifier or shock absorber, which type are you? And this depends on the strategic substitutability. So if you look at this, essentially, if the others hold fewer assets, you want to hold more assets because this is going up as the others is going down. And if there's a shock, essentially there's a shock of a size of 10, let's say, the fundamental shock is a size of 10, then the asset price declines only by 9 because it goes down by 10, but then there's a stabilizing effect going on. Now, you can view as a run-up, there's nothing going on in equilibrium. So in equilibrium, the equilibrium price stays the same, but you have this run-up in the background, a hidden run-up, where you have essentially the best response curve shifting, but it's all off equilibrium. It only shows when there's a shock. So it's off equilibrium, so you have this best response. The best response is shifting, but the equilibrium stays the same. But after the run-up, when then there's a shock, then the system is vulnerable. And if now is a shock of 10 occurs, if now a shock of 10 occurs, then instead of having the stabilizing effect, the shock of 10, you have this amplifying effect. It goes all the way from here to here. So you have this, first round, second round, third round effects, and the whole thing is amplified. And if the strategic complementarities are strong enough, so here the slope is larger than 1, then it can even happen that you jump from this equilibrium to another equilibrium. So you also have multiplicity. Okay, so that's essentially. So this is amplification and multiplicity. So essentially what this run-up is, in the background, you don't see any changes, but there's a change in the best responses. You move from a strategic substitutability frame setting to a strategic complementarity setting. And I mentioned this already. This is just the literature whether the leverage cycle is countercyclical or procyclical, and there's a big controversy on this topic. Now, another thing you can understand is if you want to understand, for example, margins and what are the impact of margins and on fat tails, what are the return distribution implications? Now, why do we have fat tails? Okay, so how is this related to strategic complements and strategic substitutability? And typically what you have in the real economy, the financial market is very good in handling small shocks, but it's very bad in handling large shocks. So for example, typically it's the case that small shocks are mitigated, are reduced, and large shocks are amplified. Okay? And that's, you can think of this, you have the strategic substitutability in some range, and then it becomes strategic complements. Okay? So now if I have a small shock, so the small shock is stabilized, so the small shock of, let's say, of size 5, it leads to an equilibrium shock of 4. But if I have a large shock, a shock of 15, it leads to an equilibrium price change of 20. Okay? So small shocks are mitigated and large shocks are amplified. So if I were to then look at the return distribution after I've observed that in such a setting, I will get something like this. So, the small shocks are mitigated, so the distribution moves over here, and large shocks, suddenly there's some fat tail showing up in a stylized way. And you can also show in this graph, essentially, if you increase leverage. So, for example, we start out here. Now there's increased leverage. The price moves up. And with this increased leverage, the whole system becomes much more susceptible to a small shock might now already be. Because now we are already here in this downward sloping strategic complementarity range. Even a small shock is then amplified. Okay, that's essentially what this shows. Now, so I talked already a lot about fire cells. And the first thing is that the crisis, there was a huge, many economists disagreed what is the definition of a fire sale. Okay? So what is it? What we think is it's just it's a sale of an asset from the first best user of the asset to somebody else who is not the ideal holder of the asset. Okay? And that leads to depressed price. So let me ask you an interesting question. Are fire sales bad or bad? Let's suppose there are two groups. There are some experts. The experts hold this asset. And then some non-experts, some households. We will see this later when Yuli is presenting. And if there were no households there where we can fire sell these assets, would this be good? You know, if these households would not be in this economy, they're only experts now. And I mean, we don't have this, and we can't really offload these assets. Is this a good thing? When will the asset price move more? With fire sales or without fire sales? With fire sales.
The price of
the underlying asset. Let's suppose there's no second group there. Now there's a negative shock. Will the price drop more when you can fire sell it? Or let's suppose the second group is not there. You have only a shadow price. Will the shadow price drop more or the actual fire sale price? That's is essentially one can see that if you can sell it to some other group, they are stabilizing force. You know? If there's no group out there, the price will drop even further. Okay? So you take this group away, so the price will go down much further. But the question is this good or bad? I sell essentially an asset which is very well managed by this expert group, and they're selling it to some other group, which they're not so good in managing this asset. So in terms of allocation, it might not be such a good thing. Okay, but so that's where the welfare implications are very tricky. So it's not obvious. Okay, so the fire sale actually, the fact that there's a second group out there is actually stabilizing the price. But it leads to a less optimal allocation because I fire sell an asset from a group who is really good in holding this asset to another group which is not so good in holding this asset. Okay. Then there's, of course, the other component to it. If I now go to ex ante perspective, it might be that these experts lever up too much, okay, because they know they can fire sell it to this bad group. Okay. So that might also be a bad thing. So there are many different effects going on. So it's not easy. So when I did this vote, you both can be thinking, well, they're right. Because whether it's a fire sales are good or bad is quite tricky to answer. But typically, if you read in newspapers, they would say fire sales horrible. We have all these fire sales. We have to stop these fire sales. But you could say, oh, yes, let's stop it. But then the price drops even further. There's no group catching it, essentially. But once you have this group catching it, the price will be less volatile, but the allocation might be worse, and the ex ante distortions might be much bigger. Okay, let me jump. So, in terms of, I mentioned already, this pro-cyclical, counter-cyclical leverage. There's some controversy going on, and leverage is also related to margins. So when the margins go up, then actually you have to reduce your leverage. And this was especially in the financial crisis with the so-called repo run. So repo run means essentially there's a leverage has to go down because whenever you buy an asset on margins, so you want to buy an asset which is worth $100 and you have a margin of $10, so $90 you borrow and $10 you have to fund on your own. Okay? And if there's a margin spiral, so repo run, margin spiral, these are just different words for the same thing. The margins essentially go from $10 to $20. You have to come up with more of your equity. So what you do is you reduce your position. But if your initial leverage is you go all the way to the constraint, so you have 10 to 90, and then the margins go up to 20, then you have 20 to 80. So the leverage is going down. So if the margins move in a particular way, you would get automatically the leverage cycle. Okay? So that's in models where there's a margin going on or the margin spiral is going on, where in times of crisis the margin is shooting up, then it is the case that you get a countercyclical leverage. Okay? Or pro-cyclical leverage. So in times of crisis, the leverage is going down. Okay. And that's typically the case when the volatility is time varying as well. So I mentioned already the collateral constraint often is the worst outcome or the value at risk. So if suddenly the distribution becomes more wide, then the value at risk becomes much bigger. That means you can borrow, the margins are going up. So in times of crisis, the margins are going up. So instead of $10, you have to come up with $20 on your own. And you can only fund, instead of $90 in debt, you can only fund $80 in debt. So I will skip that because otherwise I won't have enough time for Yuli too. So the next thing in the crash phase I would like to emphasize is this paradox of prudence, and that's what Yuli and we call what's microprudent need not be macroprudent. This will come up also in the I theory of money, which Yuli will present this afternoon. There's this famous paradox of thrift, Keynes' paradox of thrift. So if you say, okay, we have a situation, and we go into a recession, suddenly we said, oh, I have to tighten my belt, I have to save more, my savings rate is actually going up, but my savings is essentially, if I save more, I consume less. If I consume less, your income is going down because my spending, my consumption spending is your income, so income goes down. So the paradox of thrift essentially said if we all become more thrifty and try to save more, we might all save less in aggregate. That's a fallacy of composition. That's what Keynes pushed very strongly in order to understand the Great Depression. So we all try to save more, and by all saving more, we spend less, and by spending less, we ruin the income of the others. So overall, the whole economy shrinks, even though we all try to save more, and ultimately, in dollar terms, we save less. So we push up the savings rate from 10 to 20%. And it's true that the savings rate will be higher, but the income is going down in aggregate so much that the savings in dollars will be lower. Okay. And what Keynes did for the consumption savings behavior, we can do the same thing for the risk-taking behavior. So that's essentially what this paradox of prudence, so the term we just adopted, paradox of thrift, Keynes' paradox of thrift, but just use it for the risk space. If everybody tries to reduce its risk, so becomes more microprudent, it can be that the whole macroeconomy becomes more risky as a whole, and then because the whole macroeconomy becomes more risky, it is essentially macro-imprudent. So let me put it in other words, you go into a recession, suddenly everybody says, oh, we can't take on so much risk, but taking on less risk, the whole economy becomes more risky, and overall the economy has to hold more risk. Okay. So you can have amplification, and amplification works essentially for the same asset. You can also have spillovers across assets. So amplification means essentially there's a spillovers across agents. I want to cut back, others are cutting back, and the asset price drops. I want to cut further back, so it works across the agents. Of course, you can also have some spillovers across asset classes. Now that's also very much there. So let me go to the recovery phase briefly. The big puzzle was essentially for the last recession, why did it take so long to recover? And that's very consistent with many of these financial friction models, where you have, in Kiyotaki-Moore, you have, for example, you have this one-term shock, and then it lasts for a long time. But if you go back into the literature, this persistent, in many of these models, you have a one-time shock, and then it takes a long time to recover. Even though the shock is just temporarily for one period, it takes a long time to recover. And the classic papers in these financial friction models, of course, the Spernaky-Görtler 1989 is one of the first models, but that's an OLG framework. The Kalsterman first is one of the first ones where you show you have a temporary shock, and then it lasts for a long time to come out of that. So a negative shock to net worth. So you have a negative shock, it destroys net worth, it makes the financial frictions worse, and then you have to rebuild your net worth as you make profits, retain profits, until you go back to the old steady state. And so what you have in this Karlstrom and Fürst paper, that's essentially what I said. There's a negative shock in period T that decreases the net worth. This increases the financial frictions and decreases the investment. And this decreases essentially capital supply. So this leads to a lower capital stock, to a lower output, a lower net worth, and it feeds back and so forth. And this lasts for a long time. So what's interesting in this Karlstrom and Fürst, however, is that you have essentially a dampening effect. So it is the case you have a one-time shock and lasts for a long time, but there's also an element in it. There's a one-time shock and there's no amplification. It's actually an anti-amplification. Okay? So in Karlstrom and Fürst there's a decrease in the capital supply. Because of this decrease in capital supply, so less capital is produced, physical machines are produced, the value of machines is higher. If the value of the machines are higher, that means the net worth is actually also higher because these experts, they have these machines, so the net worth is higher, and that cushions the collateral constraint. Okay? So it's dampening. There's no amplification. It's the opposite of an amplification going on. So that's Karlstrom and Fürst. In BGG, it's the opposite. It's actually a capital demand shock. So instead of a capital supply shock, the capital demand shock is depressed, and now the price of capital Q is actually depressed. Okay? And that, instead of leading to a mitigating effect, it leads to an amplification. Okay? So there's a negative shock, so there's now less demand for machines or physical capital. Q is depressed even further. This tightens the collateral constraint, and this makes the whole thing even more dramatic. And they amplifies the L effect. So in both models, it's the case there's one temporary shock leads to a persistent shock. It takes a long time to grow out of it again. But in Karlstrom and Fürst, the initial amplification, there's no amplification, it's an anti-amplification. In BGG, it's an amplification. And yeah, I won't go, given the time constraints, I won't go through this model. In Kiyotaki-Moore, I should say in BGG, in Karlstrom and Fürst, the framework is similar in many other dimensions. The frictions is based on a debt contract, and the foundation, it's micro-founded with a costly state verification a la Townsend framework. In Kiyotaki-Moore, they have this collateral constraint. And here, what's going on is that you can fire sell the assets to this other group. So I didn't fully answer you. In BGG, you can scale back the capital stock. You can essentially uninvest. Okay, that's another way of reducing the capital stock. So it's not totally irreversible. While in Kiyotaki-Moore, at least in the first part of the paper, it's a fixed capital stock. You can just shift it from one group to the other group. Okay, that's this fire sale going on. That's why I call this here extreme technological illiquidity. In BGG, you have some technological liquidity because you can uninvest to a certain degree with certain adjustment costs playing out there. And but otherwise, it's the same thing. So let me just jump to the critique on one could make for the Kiyotaki-Moore framework, essentially, and also for the BGG framework, is that there's a one-time shock, and from then onwards, even though it's a temporary shock, it is a long-lasting, but it's deterministic. So you go back to the steady state in a deterministic fashion. So everybody knows exactly what the next period's price will be. There's at one point there was a zero probability shock, which was a negative shock, and then you go back in a deterministic fashion. So there's no uncertainty how long the crisis will last. Okay? So you know exactly there's a recession, and it will last X periods, and then we're back to the steady state. At which speed you go back. So this is the single shock critique. And typically the way you depict this is with impulse response functions. What Yuli will present is much more the volatility itself is dynamic. Now, there's not a zero probability shock, there's the volatility, and the volatility is moving around as well. Okay? And there's constant shocks all the time. It's not the one single shock. So you don't know how long the recession will last. And in particular, if you go into a recession, actually volatility is shooting up, and that leads to more precautionary motives as well. So you want to save more, and that amplifies the whole thing. So the whole volatility dynamics plays into the whole setting as well. So the volatility dynamics is the novel element, which I think is another way to create more amplification because of this increased volatility. So let me just conclude with 2 slides, or once. I conclude now with 1 slide before Yuli takes over. Why financial regulation? So that's a personal take. So if you go back in the last 20 years in terms of research, of course you're too young to but there was an internet bubble, the Nasdaq bubble in 2000. And what happened is that in economics, there was essentially a huge pickup of behavioral research. Okay, so before the 2000s, there was, of course, some Kahneman, Thaler, and all this did behavioral research, but it was at the fringes of the profession. And of course, there was an MBR group, but this was a small group, but it was not at the core of economics. Core of economics was very much rational models driven, in particular in macroeconomics. What happened with the Nasdaq bubble, essentially there became suddenly a huge boost for behavioral economics, for bringing psychological and non-rational expectations into the framework. So these belief models became very, very popular. Of course, there was heterogeneous belief models were before that, but it was very, I would say not at the center of the research. Now, when there was a Great Recession, on the other hand, you might have thought, okay, that's also a revival. It will strengthen behavioral insights even further because all this craziness about the housing bubble and all this, what's going on. But the big difference between the Nasdaq bubble and the housing bubble was essentially that the regulators wanted to know what to do. How should the regulatory framework change? So the big deal was your Dodd-Frank and what should be in Dodd-Frank, what is the underlying rationale for doing certain things. And we have a very good understanding to model things with externalities in a rational framework and say, oh, here's the motivation, here's the market failure, and that's how we have to intervene. But we don't have this with a heterogeneous beliefs framework. If you go to behavioral, it becomes paternalistic, and you say, why should the regulator have better beliefs than the market? That's not clear. And that's why it's, at least my interpretation, the boost the behavioral research got after the Nasdaq bubble, they didn't get it all, because after the housing bubble, it was primarily on the financial crisis, it was primarily how to regulate the financial sector in a more stable way, and we didn't have a good welfare benchmark for the behavioral models. And this lack of a welfare benchmark actually led to a thinking which is way more driven by rational models, driven by externalities and other market failures, rather than driven by behavioral elements. And that's why I think there's another agenda, which I think to have a welfare thinking, what is the good welfare benchmark, welfare measure, and how to do welfare with less rational models. I think that's actually a very interesting agenda as well.